And just in terms of the companies that you're following, like when I read through your monthly report, I think 19% of the companies or investments you have, you said, relate to or are pretty much exposed to mining services. That's a pretty big swing in terms of exposure. First tell me about, like, obviously there's some appeal, but talk to me about the downside of having that big of a position in the portfolio.
Yeah, it's up from 0 18 months ago. And I think that's one of the things that's given us a bit of perspective on the space, is that we didn't own any of them. And we're very, very cautious about the outlook from China and the outlook for the mining market in Australia. So we're coming at it from a very pessimistic perspective, but are finding some fairly extraordinary value on the ground. Look, we've got that 18 or 19%. I'd say it's split 50-50 between businesses that we would consider fairly risky and that we fully accept that there's going to be a few mistakes in there and some things go wrong. On the other side of that 50%, some of that stuff should probably go up 4 or 5 times, and we hope that it'll all even out into a decent return. The other half of that we think are either fairly good quality businesses that we're reasonably confident about the outlook for, or they're exposed to mining services in a part of their business, but they've got another part of the business that's got nothing to do with mining services, and where we think there's enough value to justify the price in itself. So look, there's risk there. There's always risk in stocks, but in the market at the moment, we're a lot more excited about having 17 or 18% of the portfolio in this sort of stuff than buying overpriced, good quality businesses, which is what we're seeing a lot of elsewhere in the market.
Mm-hmm. And you've said in your report that you sort of are half expecting a couple of these things to potentially have a clangor or a bit of an explosion or blow up. Can you just talk about the actual structure of the portfolio and how you cater or factor that in?
Yeah, so we would typically hold 14 to 15 stocks in the portfolio, and we run a concentrated portfolio. When we find a stock we like and that we're comfortable about, we'll typically have up to 10% of the portfolio in it. So 2 IT companies that we really like at the moment, Hansen and GBST, we've got almost 10% of the portfolio in those 2 stocks. In this mining services space, what we want to own is a bigger basket and smaller positions in each of them, because we're very aware that some are going to work spectacularly well, some are probably not going to work. So we must have now, I guess, sort of 7 names in that 18 or 19% that we talked about that are 2 and 3% positions. And for us, that's a small position because we run a concentrated fund, but we want a basket here that's exposure to what we think is a very cheap sector, rather than us saying this is the one stock that we think is going to work. We're fully aware that there's a lot of variables out there and a lot of things that can go wrong in this space. Yeah, we buy asset values really, so this reporting season has been really important for us in terms of seeing how our theses are unfolding, because we went into a lot of these stocks thinking we're buying this really, really cheap on the back of cash flow and on the back of asset values, and on the assumption that at some point it would stabilise and you'll start collecting that cash out of the business as a shareholder. So this reporting season is really the first one where we've started to see that stabilisation take place. We've started to see some businesses are still winning work out there, and they're still generating profits, and they're still paying dividends to shareholders. So there was a little company mentioned in that monthly report called Briety, which we own, which is talking about an order book for next year that's a record order book for them. They don't have much debt on the balance sheet. They pay a fully franked dividend. When we bought it, it was trading at sort of a bit over 4 times earnings. So it's just the magnitude of the discount to value there that's attracting us, rather than any view that the sector's going to turn around or that it's all of a sudden going to come back into favour. We just want to own stocks that are cheap, and generally good things happen when you buy them cheap enough.